I wanted to do one thing, and that was to read to you one of the most beautiful paragraphs in the English language. It was written in 1942 by a fellow named Joseph Schumpeter, who happens to be my favorite economist. And so, for better or worse, you get to hear about him today because I like him. Interestingly, the book is Capitalism, Socialism, and Democracy. I can't quite recommend it to you, but I can tell you that it changed my life. And so I think you're going to have to suffer through the next 3 minutes. The chapter that he wrote this very famous passage in was called Can Capitalism Survive? And I thought as we were putting together the panel, it's not a bad way to kick off the conversation. So let's see whether you agree. He wrote this in 1942. I'm going to paraphrase a few things. The history of the productive apparatus is a history of revolution. The opening up of new markets and the organizational development from the craft shop and factory to such concerns as U.S. Steel illustrate the same process of industrial mutation, if I may use that biological term, he wrote, that incessantly revolutionizes the economic structure from within, incessantly destroying the old one, incessantly creating a new one. This process of creative destruction is the essential fact about capitalism. You may have heard the phrase creative destruction before, but what I think is beautiful about the paragraph is it fleshes out the idea as so much more than just a catchphrase. And hopefully, maybe not, but hopefully it will be a jumping off point to our conversation about the consumer internet, because I see a lot of creation, but I also see a lot of destruction. So what I'd love to do as an intro is maybe just quickly go down the table and hear from Gina, Brian, and Martin, and I'm going to ask them a very pointed question, which is, what do you do every day for a living, and what pets do you have? And the pets issue is, I think, a good way to quickly get to know whether you're a warm, loving person who invites animals into their home, or whether you need to talk to somebody after the panel. So, Gina, let's start with you. What do you actually do every day at work?
Thank you for that introduction. Oh, that does work. Okay, good. Hi, my name is Gina Bianchini, and as a CEO of a rapidly growing startup company, I get to define what I do every day, and that could generally be bucketed into dealing with sort of the hottest fire that sort of appears that morning or that evening, working on, a second bucket would be working on the product itself, because there is nothing more important to a startup than the product that you have and the product that you're evolving and the product that you're iterating. And then the third piece would be management and growing the company from a small company to, we have over 120 people today. So there's management involved. So that's really sort of how I think about my time. And in terms of pets, I do not have a pet right now, primarily due to scheduling. But I do...
Pets are very busy in your life.
Yes.
Yeah, the animals are very busy.
Yes,
yeah.
Yes, they are. But I do talk often with my husband about getting a pony, because I think that would be really cool.
Wow, that's really going from 0 to 60.
Exactly.
But perfect answer.
Thank you.
Brian?
Hi, thanks for having me here. My time is probably split a third on existing portfolio, a third looking at new opportunities, and a third other, which includes networking, firm management issues, coming to events like this, learning about trends, etc. As far as the new opportunities go, it's really all about triage as a VC. You have, in good times, bad times, there's always plenty of deals out there, and it's really a matter of figuring out the select few that you could spend time really doing deep due diligence on, and making sure that you have the proper turnover so that when something even better comes along, you can jump to that. So we could talk more about how the process goes. You guys are here, you're sophisticated, you know how the process goes, but maybe we could talk about what's current in VC land. As far as live warm bodies, I have a 2-year-old and a 6-year-old, and they're happy when I come home, so I think with one species I'm doing okay, but you see.
Those are humans, yeah?
They are.
Yeah.
Most days, not all.
So I'm the Chief Operating Officer of Meebo, and I was brought in about 2 years ago with the 3 co-founders. The 4 of us run the company. And my job as kind of an operator is to make sure that the product strategies are in alignment with our overall goals. So if we have a goal of growing or if we have a goal of revenue, both of which are our major goals, that the things that we do are in alignment with that, and then we're doing them the right way, and we're doing them in a speedy fashion. So it's not so much about the vision or the pixels, but it's more what are the projects that are going to get us there, the results that we want, how are we doing them, and when are they happening. So I have a confession on the pet front. I have been a dog owner since I was 4 years old, Labrador Retrievers.
Excellent.
And George, our 6-year-old lab, is on holiday with my mother in Vancouver. Because when I left my old job to start at Meebo a couple of years ago, we had 2 little kids under the age of 2, and George had to go keep my mother company.
So it's an extended getaway.
Yes.
For him.
He's been on holiday for 18 months now.
Were you upfront about the terms of this with him when he left?
He and I were on the same page, but I wasn't forthcoming with our 2-year-old. So.
Now just observe how much closer you feel to these 3 people after that experience. It's going to be good, this panel. So I'd love to start and get your take on something that happened. I guess it was probably about 5 or 6 months ago. Sequoia Capital, very well-regarded venture capital firm, one of the oldest sort of and most successful of the bunch on Sand Hill Road, called all of its CEOs together and delivered a PowerPoint. And I wasn't there, so I'm just going based on rumors, which I always believe from the internet. As
well you should.
That they delivered this PowerPoint in the first slide, and I wanted to get it, but I felt guilty because I believe it was actually not supposed to be distributed. But it was a tombstone that said, "Rest in peace, good times." Did folks see this? Yeah, scary stuff, but it turns out not that far off. What were your thoughts then, and what are your thoughts now about the ecosystem in which you do business? Is it kind of really rest in peace, good times, or are there signs of life, and where do you see them? And anybody just jump in.
Well, the first thing I would say is that it was a really there is nothing that comes out of that particular esteemed firm that is accidental. So it was absolutely done on purpose, and it's very good for Sequoia. And I think that that's perfectly fine. They did a lot with that presentation to really just scare the bejesus out of people. And I'm sure that there was actually fallout in terms of everything I've heard, fallout with other VC firms and the deals where their companies were looking to raise money and things along those lines. That being said, I think it was a really good wake-up call in the sense that, certainly coming out of the bust, sort of the first time around, and I graduated from Stanford in 2000, so that was an awesome time to get into the market. It's great, but it was, it absolutely is true that startup companies need to manage themselves very tightly, be very scrappy. The good news is the cost of actually doing a startup today is dramatically less than it was even 3 or 4 years ago. But I also think fundamentally that managing, certainly the companies that are Series A going to a Series B, or who took advice that is out there that raise the least amount of money that you possibly can. I think there's a number of companies that are going to get caught in the crossfire and just basically bad timing, and you will see those companies go out of business. And I think it's starting to happen. It is interesting in the sense that in the last economic recession in 2001, 2002, we were the nose. We were the beginning, and everything was sort of exploding from here. And in this case, I think we very much are the tail, in the sense that it's sort of getting to us, much later than it is other industries and other companies. But I don't think that it means anything more than starting a company in 2009 or running a startup in 2009. You want to be as scrappy as possible and really control your own destiny by being a profitable entity.
As soon as possible, yeah. Brian, what's your view on this in light of the rest in peace, good times kind of mantra?
Yeah, I think it was a good wake-up call, but frankly, it was one where if you were sitting managing a company that was sort of fat and sloppy and unfocused, there's never a time where that's an appropriate way to run a company. It should never be out of favor to be focused and manage your cash carefully and treat every round of financing as if you should make it your last, et cetera. So, but reality is we can all always, tighten the screw one more turn, and that had that effect. What I'd say we're going through now, we're kind of seeing companies fall into three buckets. There's, at the top, the ones that are either hot or really good or both. And those companies, as you see from recent high-profile financings like Twitter, they're doing just fine. They're going to be able to raise money. And the good ones, by that I mean who have real revenue and real business models and are at break-even or more, they're actually seeing this as an opportunity to gain market share, to solidify their positions. And you know what? Their competitors are falling away and acquisition opportunities are showing up. So life's good if you're up there, really good, in fact. You're not going to have necessarily your record year of growth, but when you come out of it, you're in good shape. The middle are the companies that it's too soon to tell or need some work. And life's tough there, but manageable. It takes the focus and the cost cutting, et cetera. At the bottom, though, that's where it's pure pain and agony, and you won't get funding and probably fail and move on to the next thing. And every portfolio has some distribution of those, and you look around and you see companies in all three of those categories. So it's tough, but this is the markets.
I would say revenue is coming slower, but in terms of actual growth, especially in the consumer internet, if you look across all of the services that are growing, the growth rates have actually accelerated for a number of companies in January, certainly February, and that's because people have more free time. So revenue's coming slower.
Including these folks here, apparently.
Right.
Well, and that was true of the last bubble bursting as well. It was a stock market correction, but if you look at any other metric of fundamentals, page views, uniques, broadband households, e-commerce sales, it was all steady up and to the right.
It is very unlikely that where people are going to reduce buying DVDs, they're going to reduce going out to the movies. They're going to basically get rid of cable all before they actually get rid of their DSL or cable connection to the internet. And the fact that you can do so much more on the internet, I think you're going to see an explosive year of usage growth. Now, there's other issues in terms of revenue that I'm sure we'll talk about in a moment. But in terms of actually building services that are getting scale and getting adoption, now is a phenomenal time.
Martin, what's your take?
Well, Sequoia did our A round and has been a partner of ours for many years. So I'm absolutely bound to say that it was exactly the right sage advice. And it was exactly the right sage advice. I mean, I think that they were actually way out ahead of how bad the recession is still going to be. And I think there were a lot of people at the time, and in the month preceding that was sort of saying, well, this is a financial thing. It's New York. It's not going to really affect. Maybe China's disconnected from the rest of it. I mean, they saw it early, and it was well prepared. And so it was sort of one message that came through from that big slideshow was take the necessary cost actions, cash conservation actions to survive. You cannot succeed if you run out of cash. And so that's a lesson we all should know. As you said, every financing you should operate as if you don't get the right to get another one. And I think that was sort of a wake-up call to a lot of people, and it should be. I was an operator at CNET Networks for 10 years and was architected a $150 million cost reduction in the last downturn. And the sooner you do those things, the better you go. So one of the messages was, if you're going to do cost cuts, don't do them over time. Do them once and then recover. And this is sage advice. So I think on cash conservation, survive, many entrepreneurs lose sight of that. You have to have the money to keep the payroll going. It doesn't matter how good the designer is. If you have to lay them off, they're not that good anymore. And then the second piece was the focus on the customers and focus on being aggressive on the reduced scope of what's really important. So reduce the things that you do to the most important things and make sure you do them well and very, very aggressively. And I think that's really good advice as well.
What actions did you see companies take over the last few months that you particularly admired, or best practices, whether inside your companies or others of friends that you know? How did folks approach this problem of cutting expenses or making the cash last longer?
I was particularly impressed showing up at some board meetings where the conversation didn't even need to happen, that the group said, management team that is, we were going to raise around next quarter. We've decided we don't want to do that. We don't want to have our destiny controlled by others. We've decided to take 10% across the board salary cuts. We're going to defer the bonus, and we're letting 5 people go. And so just a proactive approach that had no drama in the boardroom. It was just they realized this is what we need to do, and life will be better for all if we get there sooner rather than have to debate this for 2 months.
Gina and Martin?
I'm a big believer, and in part this is having lived through starting a company and running a company from 2000 to 2003, that you should always operate your company as if you are the scrappiest startup in the entire world. And so for us, what we have certainly attempted to do is, keep our costs as low as possible. When somebody is not working out, we make those decisions very, very quickly, in part because we think it's fair to the person and we think it's fair to the company. So for cultural reasons, we don't have a lot of extra people that aren't a really good fit and who aren't sort of producing and having a great time, doing fantastic work. And then we also raised a significant amount of money, in part because we had one of our investors call us in January of 2008 and said, if you're ever going to raise money again in the next 5 years, go raise it right now. And that's what we did. And so I think we sort of saw the very tail end of a very interesting financing window. But when we raised the money, my first comment when we did our all-hands meeting at the company was, we're not buying beanbags and like a foosball table. We are going to continue to run the company as if we don't have any cash, or a very little amount of cash. And that served us very, very well. But it is absolutely, it's very easy as a startup, especially in a market that's growing very rapidly, and you're looking around at other companies and everybody's, growing and hiring, and the worst is when you just hit the wrong point where you've been staffing up and you've been building the company for this kind of growth curve, and it comes in at the same time there's no money sort of left. So it was not an easy decision for us, for example, to raise, as much money as we did. The valuation certainly helped. But we actually could have raised more money than we actually did, and in fact more money than we actually wanted to. And we were sitting there and we're like, should we take this additional money that's essentially being offered to us at a very healthy valuation? And my business partner and I looked at each other and having both of us having lived through it, but certainly. When offered money, always take it, was sort of the thing that finally let us take what we did, and I'm very, very grateful that we did.
You've all mentioned in one way or another the idea of scarcity, prioritization, triage, I think was the word Brian used. How are you deciding what to invest in? And if you had advice for these folks who have time and money to invest, where would you advise that they focus in the consumer web? What do you see that's exciting there as an investment opportunity?
Well, there are a couple of big themes out there. One of the most exciting to me is solving the problem of more and more of our time is spent on social sites and using the web as more of a communications tool, and yet that has historically been a tough thing to monetize. There's this opportunity out there, though, to create kind of the Google filtered through your friends. So to actually go to the web and rather than just finding what random webmasters have driven a search algorithm to show you as the first results, it would be what your friends know about something. So this is a theme that has massive importance, I think, for taking these little digital droppings that we leave everywhere as we communicate and post and tweet and blog, etc., and turning them into something that's useful to the consumer, which is, give you information at the time you're looking for it, filter through your friends, and if that all happens, there's lots of money to be made. And both of these folks play in those sorts of worlds as well. So, I don't know. Is that an interesting theme to you guys?
I actually think, and Martin, I don't know if you, I'll keep it short. I actually believe friends is an artificial filter. And I that is sort of ironic coming from somebody who runs a social networking service. But I think it's really about your interests and your friends. And I think what I believe is going to happen and is in the process of happening is, one, if you sort of use the analogy or look back in history, AOL, CompuServe, Prodigy, phenomenal services in terms of getting people online. And they had a narrow and fixed view of what people could do with them. And what the web offered was essentially a massive fragmentation based on slightly different experiences and interests and niches. In a sense, they were all mini websites or mini AOLs, CompuServes, and Prodigies. So what I think is going to happen, moving forward, is certainly you're going to organize your life not only by the people that you know and the friends that you have, but also by the interests that you have. And that basically the tools are going to get better and better and better for keeping track of lots of different types of social experiences all across the web, and that you'll be able to have essentially a portfolio of different social experiences out there. And the way in which this is going to continue to be managed is through feeds. So I think feeds are absolutely core mainstream consumer behavior. I think they're only going to get more and more interactive as we proceed. And there's going to be more and more interesting things that you'll be seeing in your feeds, whether it's your Twitter feed or Facebook feed or friend feed, feeds galore. And then I think the other big thing that is happening, and I would say for probably the past 10 years, everybody's been talking about, mobile's going to happen. It's right around the corner. It's huge in Japan. Every other country in the world has mobile phones as their main means of accessing the internet. I think it's finally actually happened in the U.S. And if you look at the fact that it's the services that really have that combination of mobile and web experiences where you can basically consume via mobile and also insert via mobile, I think that is really where the world is going and is incredibly powerful. So I think it's going to get more and more interesting. I think it's a phenomenal time to be in the consumer internet world because of the fact that there's continuing fragmentation in terms of where people want to spend their social time online. But at the same time, the tools are getting better and better and better for both consuming lots of disparate information and also being able to do it across devices.
So I agree with that, and the only thing I think to add to that is less about the ideas or the products that you might build or conceive of, more about where the money comes from. A long time ago, you could build a website. If it got page views, you could put display ads on, and then later it would get figured out. I think those days are over. So display advertising, the world does not need another 10 billion undifferentiated display ad impressions, and the buyers of display advertising online are real, and they are shifting probably over the next couple of years tens of billions of dollars our way. But it's a big media company, larger media company, direct sales team kind of approach. So it's not the kind of thing I think you want to bite off as a startup. What you do want to bite off as a startup is data and monetizing data directly, or hooking in paid links from either Google or other places. The rev splits that you can get are actually quite aggressive. They're favorable to you. It scales pretty linearly with traffic. So if you can do things, good features, good products that get traffic, and you can find a way to monetize them in a way that that is performance-based, and you can tap into whether it's MySpace, Facebook, which will happen, or Google, or Microsoft, or Yahoo. They're all competing for more clicks. If you can give them clicks, you can make money. And I think that's a good place to focus in terms of where the revenues would come from.
Can you say a little bit more about that? Because I wonder what's the playbook for a smaller consumer-facing internet company? Certainly, AdSense is one option.
Yep.
At the other extreme, people have stars in their eyes about getting big media company CPMs on their highly targeted graphical inventory.
Yeah.
But neither of those is really that satisfying, either from a total gross sales point of view or a practical. They're not going to build a sales force point of view.
You have to be very big, I think. 5 to 6 million unique users a month in ComScore, not your own traffic logs, but ComScore, to get on the radar screen of an ad agency like a Publicis or a Group M or someone like that, who's going to RFP you. They're going to say, I have $100,000 for Coke, and they are looking for this demo, this display advertisements. If you won't make any money in the display ad world, really, until you can get there. And even then, you've got there's a lot of infrastructure that you've got to build. So Meebo was around for almost 3 years before we put ads in Meebo, because we needed to get big enough that we could actually be, important enough for an agency to take a meeting. So there are ad networks that will do that on your behalf. But typically, the revenues that you will get from that are pretty slim. The CPMs are very low. If you can focus your product development in a way that generates very, very, very fine-grained specificity about interests and generates action in this economic time and with those business models, that's probably, I would say, the right focus to make.
There's a lot of models that can work. It's not just ads so I think some interesting stuff right now is happening in good old e-commerce again, as well as lead gen, where you're actually delivering a qualified buyer who's going to take an action now, and you get a commission on that, or you just get the gross margin on that. One sector that's actually proving to be potentially even counter-cyclical is a niche of e-tailing, which is these private event sales companies. Gilt Group, Rue La La, Hot Look, etc. These are folks offering 70 to 80% off designer brands because all these folks have lots of extra inventory, and they're giving that inventory to these websites who are able to offer them in a private sale, a 1 to 2 day event, and then it's gone. It's not seen by Google. You can't search for an event after it's happened and see that this brand was offered for 70% off. So it protects the brand's long-term image to some extent, and it gives the consumer a screaming value, which so far they've proven they can't resist. The question is long-term, is there enough supply that continues for that? Does the consumer get fatigued? But just when you thought e-tailing was over, there's about 3 or 4 of them that are killing it. First year revenues of $11 million from zero. Pretty good.
Gilt Group, for example, has grown users and revenue 6x in the last 12 months, something like that. We took a different approach in terms of both short-term and then thinking about long-term revenue. So we have a free service where people can come create their own social networks for their choice of topic, which provides topical, highly targetable page views, which is a good thing. And basically, on our free service, we reserve the right to run ads, and we're using Google AdSense, which up until a certain point of scale is a fantastic solution, and then really sucks badly for a variety of reasons. But anyways, the other thing, though, that we did when we launched was basically giving our network creators, for example, the ability to buy that ad inventory from us for $24.95 a month. Use their own domain name, cost $4.95 a month. To remove Ning promotional links is another $24.95 a month. So for a whopping $50 a month, you can really have essentially your own hosted business and your own hosted social networking business, which has worked very well for us as we're getting to scale. From an ad perspective, we have this additional revenue stream of premium services. I also believe that one of the things that we will see in sort of the world of the consumer web in the next 12 months is everybody, and you do see sort of a lot of this in Silicon Valley, which is perfectly fine, but where 6 months ago everybody was like, advertising, targeted advertising is it. I'm an advertising business. You will see slowly but surely, now all of these businesses will be virtual gifts businesses. Yeah. So virtual gifts is basically the premium subscription of 2009. And it's fine. And if you can get to scale and somebody is willing to pay $1 for me to give you a virtual gift, it's a fantastic business if you can get it. But I do think that a lot of startups are really sort of saying, okay, Google AdSense is okay up until a certain point, but you either need a fair number of very targeted page views. So, for example, on average in social networking, the effective CPM is somewhere in the neighborhood of 9 to 11 cents. Some of the networks that we have on Ning, the one I like to use as an example is Chris Anderson, who's the editor-in-chief of Wired magazine, has a DIY drones social network on Ning, which is a social network for people who love unmanned drones. And he's getting somewhere in the neighborhood of $3.15 CPM. Nothing too shabby from that perspective. And he doesn't have any costs. So he has basically the $50 a month, plus he's able then to generate a very high effective CPM. It's a pretty interesting little business. So I think that those are some of the things that are going on today.
The other thing on the money front I would add is the extent to which services cross between the PC or the web through computers and on mobile devices. If your users think about your brand and the service across both of those, then you have an opportunity to take advantage of the carrier billing relationship. And the splits are horrible. Okay, so whatever you think you're going to charge the customer, you're going to keep the minority of it, not the majority. But the revenue per user is pretty good. Ken,
I'd love to go back to. Oh, sure, go ahead.
Yeah, I feel bad if we left this question with anyone thinking that these were the answers. Mm-hmm. I think the reality is you can find examples out there of any of these business models, mm-hmm. whether it's freemium or subscription mm-hmm. or ads or an ad network or e-commerce or B2C, if people still use that phrase, but that business model still works. By the
way, if you guys are out interviewing with companies and you come in and you're like, I've been doing B2B and now I want to do B2C, don't say that.
Don't say Web 2.0.
Yeah, exactly. Just do us a favor because I think it will be helpful.
But if you say those things, you show you've actually been doing this since Web 1.0.
That's true. That is true. B2B and B2C is my favorite stuff.
But anyway, my point is that any of these can work if used in the right context, and it's a matter of getting real and realistic with yourself and doing the math. Just sitting down and taking the time to say, yeah, if I am going for an ad-supported thing, it takes 200 million page views at a $1 CPM sold through an ad network to support a 7-person company.
Right. And by the way,
200 million page views.
10x.
A month. That's a lot. So it's just, do the math and be realistic and quickly get to a model that's going to work for your situation.
Brian, a few minutes ago you mentioned surprise that e-commerce was a hotbed of innovation in the form of some of the off-price online stuff that was happening at places like Gilt Group. Why is it surprising, or is it surprising to you guys, that e-commerce is in the condition that it's in? It feels early for the growth rate to have slowed to where it is. It feels early to have achieved 5% household penetration and not really break through any new big innovations. What are your thoughts on this?
I think consumer spending is tight across the board now. So, it is not surprising that folks are pulling back. But I think we need innovation in that sector. You're seeing basically really efficient catalogs online that do a great job of giving you the ability to search and then zoom in and do that from the convenience of your home in your pajamas. That's great, but it can be so much more, and I think the innovators are doing more. They're incorporating social so you can see what your friends think about products, etc. There's increasingly a use of video, so you can really not just see that image, but see how you wear the product, what you would match it with, hear the backstory of the designer, and really feel like you have a relationship with it and a reason to buy this brand you'd never heard of, which is to some extent an experience that may even be superior to what you'd get at a department store. And this is enabled because the tools of video production are now cheap enough that you can actually do that cost effectively. So I think there's innovation. It's coming at a tough time when consumers are guarding their dollars, but I think it will continue to grow and gain share, and it's going to be category by category. But then there'll be surprises like Zappos. Yeah. Wow, did you think that there was that much left to innovate on shoes? Probably not, until these guys showed up and showed us how to build a $1 billion revenue company in not that many years. I mean, awesome.
Yeah. Martin, did you want to add to this?
Just that I think there's also process innovation around optimization. There's a lot of retailers, they'd like to make more money per user. And so if you can help them in retargeting or understanding how to drive the average, it's been years since I was in the e-commerce side, but shopping cart size higher, then I think they will pay for that.
It makes a lot of sense. And certainly if you look at the numbers, a lot of the slowdown in growth is related to the fact that new registrations in e-commerce have tapered off, and that was the engine of growth for so many for so long.
One more idea
on
that? One of the realities of e-commerce is 98% of the people who visit your site won't buy. There are some smart companies out there saying, we can do something with that 98%. They've just showed us a lot about their intent. Way more than they did by reading a politics news story. So what do we do to offer a mixed business model where we can actually make some offers to these folks or sell that interest they just exhibited by spending time on our site, ultimately abandoning a shopping cart?
Great point. I want to go back to something Gina said about 10 minutes ago. Google. AdSense works up to a certain point. I know plenty of early-stage consumer-facing companies that rely on Google not just for monetization but also for traffic generation. At what point does Google stop becoming a help and start becoming a hurt? Or maybe asked another way, is Google your friend or is Google a competitor?
Google is absolutely not a competitor. They are an enabler, and they're a phenomenal enabler. I really think that so much innovation continues to happen not only because the cost of actually creating a company today is so much lower than it was 3, 4, 5 years ago, but the fact that you can go and set up an account, take a little snippet of code, and put it on your new website or social network or whatever you want it to be is profound. It is absolutely profound. We hit a point in scale where we need more from them, and it's hard to get more from them. But that is probably more the exception rather than the rule. And I also think that they do what they do so well, both in terms of search, but also in terms of targeting AdWords and AdSense, that I think they've been very smart in the sense that by focusing on the things that they are really good at, they have been able to really be the growth engine and the revenue engine of so much that's happening on the web today, which I just think is phenomenal.
And you said, right, flat out, you don't view them as a competitor. How can that be, given their ambitions in sort of connecting people socially, and actually whether it's groups or some other product that has TBD? But why aren't they a competitor to Ning?
Well,
or a theoretical competitor?
Yeah, I mean, I think in part because so much of what they do is about machines and machine learning and basically optimizing lots and lots of servers, which is fantastic. They haven't really done sort of the bottoms-up people stuff. And then if you look at the fact that, again, I think one of the benefits of the economic environment is the fact that they're pulling back from areas that they were investing in that aren't sort of fully making it. So I think they have such a strong business in what they are doing that their ability to continue to grow based on search, AdWords, AdSense, and the other sort of experiments, it's not a bad job if you can get it.
Martin, do you agree with everything that Gina's just said, or would you like to take the other point of view?
I wouldn't take the other point of view. I mean, I can't say that Google's not a partner just to make the panel more interesting. We let people connect into Google Talk, and we work with Google as well. And I think the reality is that the I'll say two things maybe. One is that in the offline world in media, you have the Time Warners of the world, you have the News Corps of the world, you have the Disneys of the world, and you know what? At some level, they compete with each other, and then you have GE-made television productions being aired on Fox, and they work with each other. So there's a lot of stuff where there's just overlap in certain areas and competition in certain departments. That's just natural. It'll happen in every industry like that. I think one of the interesting things that's happening with the rise of Facebook is just to see the dynamic between Google and Facebook. And I don't we work with both of them, so I don't want to go too far, but there is something going on very interesting around data and around their social ambitions and monetizing with targeting and that kind of stuff. It'd be interesting to watch.
It's tricky to...
go
ahead.
I was going to say, what they've done with Open Social is fantastic. So basically what they've done is they looked at Facebook and said, okay, Facebook apps totally taking off. What Facebook is doing is fantastic, but Facebook is building it out as a walled garden on some level. And we make a lot more money when everything is happening on the open web. So if we take that, which is a closed standard, and turn it into an open standard, and let everybody take advantage of it, then we continue to be the enabler that we are. And so I think that they're doing a lot of really smart things along these lines that we certainly are taking advantage of, and I know a lot of other companies are as well.
So, Martin, it's tough to dangle out there the Google-Facebook issue and
leave it at that.
And leave it at that, yeah. So I'm going to dive in and say, and speak directly into the microphone, but give Mark Zuckerberg your best advice on what his next move should be in this chess game over...
I'm not going to be giving Mark Zuckerberg advice on that.
Oh, but he might be watching. We don't want to miss the opportunity. No? Maybe next time. No. Brian, did you want to give Mark some advice?
Well, I think they're in the best position to capitalize on this social search phenomenon. When I go and search on Facebook today, I don't get satisfying results, but I could, because they really know what my friends are doing. And with Facebook Connect, and although Beacon didn't work out, you could see them coming, back with a modified version of it. And they're in the best position of anyone. When I'm searching for a coffee shop in San Diego, or a new mountain bike to buy, or where to go on vacation, tell me what people who I trust and who I've calibrated tell me what they think. And I'd rather hear that than some random link that I get from Google. So I think they have an awesome opportunity. It's really hard because not all the information is on Facebook. But with the news feed and Facebook Connect, I think they have the rights to a lot of that information because we've all chosen Facebook as our preferred social network. So that's a big opportunity.
Yeah, no doubt. Oh, I really like this question of giving advice. So let's pick somebody else to give advice to. Let's ask the panel to give the best advice you have for Carol Bartz, the CEO of Yahoo. What in the world?
I'll take that one.
Okay.
So she has just become CEO of one of the few companies from Silicon Valley that just was a darling of Madison Avenue. And for many years, Yahoo had built these phenomenal relationships with the Procter & Gamble's, the Coca-Cola's, their agencies at the highest levels. They were strategic partners of those agencies. And they actually did it ahead of when the Procter & Gamble's and the Cokes are putting the most significant proportions of their money online. They did it several years ago. And right now, they find themselves in a place where they're in competition with Google on search. They're getting portal display advertising competition from MySpace, who increasingly sees themselves trying to take the mantle from Yahoo in the display advertising and brand advertising space. And they have a lot of assets to play with and a history with Madison Avenue. If they can rid themselves of some of the distractions from businesses that they have no way that they will win in,
such as
some of the things that they are competing with Google on, and to focus on the tens of billions of dollars of Coke and P&G and Auto, Yes Auto, and financial services company marketing revenue that's coming online. That is a very, very big opportunity for them, and they've proved that it works.
So there was just some news yesterday, though, that they had launched a product where they could actually target their display advertising based on what they've seen you search on Yahoo, and it got a 4x lift over the untargeted.
Yeah.
So I don't know if I'd be so quick to get rid of the search, even if they're not going to be number one.
I mean, sell it to Microsoft and get the rights back for that data or something. But yeah, I mean, or maybe not, or maybe just say, look, the book value of search is so low, let's just keep it, and just isolate it. Let's not make it the keystone of our, we either win at search or we die. Maybe right. That's not a good way to run it. And I think she knows that. So, but the display advertising business, even in this economy, I think you look 5 years, 10 years into the future. That's a very, very lucrative place to be a leader.
Gina, any advice for Carol?
I think you guys have done a great job in terms of articulating sort of the strategic and just incredibly strong assets. I think she is such a breath of fresh air after the most diluted, non-controversial lack of action and just complete management cluster stuff. And, it is...
Gina, let's take down the filters if we could and just be honest.
But, she is such a breath of fresh air in terms of just speaking plainly and making crisp decisions. And I think when you have the kind of assets that Yahoo has, to have a leader who is actually leading as opposed to listening to 45,000 consultants that they've brought in. No offense to the consultants here. It's just, I think it's fantastic. So I am certainly not one to write off Yahoo, and yet I do think that in the last few years they have absolutely done nothing.
Yeah, every company needs a focus. They need a mission, and if they find themselves correctly having several, split the thing up. I mean, but Yahoo can have one mission and do it really, really well.
And I think she's the right person to at least from kind of initial reports, to make that happen.
Well, we'll find out in a few days whether Carol is listening, and if she's not, I'll be sure to forward your comments directly to her.
Appreciate that.
That was terrific. That was way better than I hoped. I think we're onto something with this giving advice thing. Yeah. Yes, please don't forget to sign those releases. What I'd love to do is, before we turn over to the audience for their questions and comments, I'd just ask each panelist one question. think of a mistake or two that you've made in the last 12 months, that one that is workplace appropriate and that you can share with the audience, that you really now look back on and think, I learned a lesson with that goof up, and here's what it is. And share that with us if you would.
I think the mistake that one tends to make, over and over again, even though, I've read lots of books on leadership and management and sat at conferences, is just not acting quick enough when something has the potential to go south. So, getting into either, whether it's with people that you hire, or whether it's with partners, or whether it's just with people that you shouldn't be in business with, or who are sort of pushing the envelope, and you just kind of get the sense of like, you know what, there's something wrong here. Trust your instincts and nip it in the bud faster before problems get bigger. Because I would say the one thing that is happening online today is something that is small and looks like a small problem can literally explode overnight. And so making sure that you're making decisions very crisply and anticipating where there may be problems and just getting out of those dynamics early and often is always better than waiting.
As an early stage VC, you take lots and lots of risk in the companies you invest. There's market risk and team risk and execution, monetization. Nothing is proven, really, if you're investing at the earliest stage. And so the mistake I keep making over and over, and I think there's a corollary, it's the same mistake that entrepreneurs make, is too much too soon. And the VC side, it's too much money before you've taken some of the risk off the table. And I keep telling myself, no tweener deals. If there's no consumer adoption proven, it's a seed. It's $500K. And figure out if there's consumer adoption before you put more money in. Or if there's adoption, then that's a real round. That could potentially take $5 million and make productive use of it. And when you do the middle ground and you put $3, $4, $5 million in a company that you don't even know if their consumers are going to like it, that's a big potential waste of money. And it's the same on the entrepreneur side, which is you hire up your team, you increase your burn rate, you do all these things, and you don't know if you're a rocket ship or, a goat. So
the goat is bad, yeah.
In this context.
Not if you're a goat.
I'd much rather be the rocket ship.
I think we're in rabid agreement. We made a mistake with last year. I'll be specific. We released some APIs because we thought it would be the right thing to do, and there was one thing we did really right, which is what they always tell you. It's a cliche because it's something you should really do, which is when you learn that you made a mistake, you just learn from it and you shut it down fast, or you convert it into something else and try it. Don't keep pushing the string. But the reason why I would actually say it's a mistake and not just you sow a couple of seeds and you see what works and then you go forward is the innovation is the middle layer. The rigor on testing and shutting them down and funding them if they work or not work is the other piece. But what comes before that is deciding what really matters in terms of the results that you want from your innovation. And so we did these APIs not because we were saying, well, we want to do these APIs because it would drive more unique users to Meebo or because it would do this. We were just like, we should do APIs because they're the right thing to do. We should have been more disciplined in the specific results we were looking for, been very creative in our innovation, and then been disciplined as to whether it worked or not. And I think that's a good model. I think it's probably pretty similar to what everybody else does. But
thank you all for sharing that.
Gina, I love your comments about AdSense, and I think it's funny because you go through this inflection point when you have no revenue at all. You slap it on, you're like, cool, we went from 0 to epsilon. And then I'm interested, I've got an early stage startup. I'm curious to know how far that'll scale. So could you go into more details about what are the kind of issues you ran into, why it didn't fit your needs as you guys got bigger, like what it couldn't do?
No.
No? You can't?
No, I'm just kidding.
Or if you came up with other alternatives?
No, and I'll be very candid. We hit a certain inflection point where we have lots and lots and lots of targeted advertising and plenty of targeted inventory. But the way in which they're structured, when we got to a certain size, they were sort of unable to do the targeting that if we were sort of one narrowly targeted website or one social network as opposed to close to 1 million social networks, that didn't work as well. And that's really what happened.
That might be unique to Gina's
yeah,
situation.
that's why I'm. For one website, I think it's good.
My previous company, CNET, Google was a tens of millions of dollars a year revenue partner for us. So it depends.
Because you can't target the advertising, you can't choose what gets selected.
We can, and we give them hints, and they're just not as effectively set up for. And yet, one of the things that we're seeing is that an individual network creator on Ning creates a social network. It has a highly targeted, topic or interest, and they use AdSense and pay us $24.95 a month. They're getting a much better CPM than we can get because there are so many different topics under our one domain.
That's a great question. Let's do this fellow here.
So I'm just curious, you guys didn't say much about subscription-based models. Is there any thought on how that plays into the mix?
So we have one. It's been working very well for us. I think there are definitely businesses, I think to Brian's point, that are doing subscriptions very, very well. You can typically, the good rule of thumb on subscriptions or on any kind of micropayments is that anywhere between sort of 2 to 7% of your user base will buy subscriptions or premium services. So as you are modeling out your own business, that's certainly sort of a good rule of thumb to sort of look at what the potential is. And we certainly have seen, about 2% of our networks purchase our premium services, and it's been great.
I would say, from what I understand, 2% is good.
Yes, sir.
Don't bank on 7%.
I've seen a fair bit of success with subscription models on the business side, where it's an individual business user who gets to pull out their corporate credit card, or if it's fundamental to them continuing to do well at their job, they'll take out their own credit card, whether it's a recruiter or a salesperson or a BD person or just white-collar knowledge worker. And I think that there's lots of examples out there like LinkedIn, one of our companies, ZoomInfo, Jigsaw, lots of interesting business models there.
Yes, sir.
Yeah, so really quickly, maybe Gina and Martin can comment on how, as your business has grown, how you've acquired more and more users, because there are thousands of startups in the Valley, and I'm sure people here, have their own companies, and people are trying to figure out how to basically go up that scale. Right now, with the scale that you have, it's probably a different game than it was at the very beginning, so maybe explain how it was along the way.
Actually, the way we grow today is pretty much the same way we grew from the beginning. And I guess there are a couple of things that I would say there. We may or may not be the right model to follow, but I'll just share with you what we did. Understand first and foremost why, even if you have 100 or 1,000 users, why they like you, what they need from you, what you're doing for them that they can't get anywhere else. Really understand it. First and foremost, keep asking them what else they need. Keep telling them what you're building for them. That's first and foremost. Because if you satisfy them in that feedback loop, they'll tell their friends, right? I mean, businesses have been built with word of mouth from the beginning of time. Ignore that at your peril. Ignore that in favor of viral marketing techniques and SEM at your peril. So start with that. And then I think that beyond that, make it easy for them to tell their friends. Make it easy for them to use your product to tell their friends if you can, if it's authentic to the way that they use your product. For many years, as a 3-year-old startup, for a long time that wasn't the case.
Since the dawn of time.
Yeah, since the dawn of time at Meebo, we have not found a good way that we thought our users could communicate with their buddies in a way that their buddies would know they're using Meebo. So Tim Draper, who's on our board, was the person who came up with the tagline from from Hotmail, and that was probably the first question that he asked when he joined our board. Hello, this model is proven to work, but in IM, it really it pisses the users off if you do that, so we don't do that. But there are other ways to do it, and we're discovering those. But that's what I would say that's the central tenet. And then I would say be transparent about what you're doing with people who can help you, who are wanting to write stories about trends. I think PR is a very good vehicle for building what you're doing, but you have to really understand it, and you don't outsource it to you. The principals of the company need to be out there talking about what they're doing.
For us, it's been viral distribution, 100%. Namely, we are adding, over 2 million users a month, registered users a month right now. 4 months ago, it was 1 million. So it's accelerating because of invitations. So people create social networks. They go in, they invite their friends invite their friends, and you've got something that has a dynamic life of its own. One of the things that we have seen that's been very, very interesting is that our social networks on Ning are getting bigger faster, and if they hit 150 people, they will keep growing by themselves. So we see all of this, but for example, we've done, just in each network, automatically search engine optimization, so it sort of pops higher in terms of the results. But that has had much less impact than giving people, I think, to Martin's point, a product that they love, and then the ways in which you can invite and manage invitations, and not only as a network creator invite people in, but then to enable and empower your members to invite people in, share things with, embeddable flash media players all over the web. All of those things are absolutely compelling in terms of driving new users in. And if you have all of those things, and I think just to echo Martin's point, if you have all of those things in place and you're still not seeing anything, go back and look at the product itself. And go back and, there's some people doing some very, very interesting things along the lines of virality and measurement. If you guys, there's a great blog, a guy named Andrew Chen. He writes a blog about virality and these different types of business models, and I highly recommend it. But what he's done is even separated out sort of the initial virality, getting somebody, what is the most compelling Google AdWord, for example, to get somebody to click through, or what's the most compelling message to get somebody to click on an email or an IM or a Google AdWords. And then once you're in, what drives recurring usage and what drives recurring behavior. And looking at it at that level of granularity, I think, is incredibly compelling in terms of growing a business virally. Totally.
You guys will all have the opportunity, and I would encourage you to think about statistics as a huge opportunity for growing a business, to look at random trial, A/B testing, and all that stuff. It is free insight, and you get creative. You do 4 versions. One's blue, one's orange, blah, 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 and you say, oh my goodness, the orange one, lift is 50% higher. Great, now let's do 5 versions of orange. That one does better than this one. And it's like compound interest in terms of your responses. It's fantastic. Stats are your best friend.
Yes, right here. Yeah, you. Yep.
Thank you so much for scaling really thoughtful and so thank you very much. Consumer internet means a lot of different things, a lot of different people, and you talked about search and social networks and detailing. I was wondering if you could talk a little bit about content, and specifically sort of how are people using content like music, media, movies, TV, and ultimately is there a world in which the rights owners will get paid for that in any significant manner?
So I believe social networking is content. And, if you look at, on our service, by far our 3 most popular features are videos, photos, and chat. So, and in that order, by the way, I should add. So fundamentally, people want to produce content and consume content online, and content in the form of videos, photos, music, you name it. So I don't sort of distinguish those or separate those out. And in terms of compensating rights owners, I mean, one of the things we're seeing on Ning is that the rights owners are creating their own social networks, putting up their own content, and then basically getting the advertising revenue from that social network. And then not only are they getting compensated for the content that they're producing, but they're also potentially earning money on the page views and the content being generated by their members in the context of the social network that they created. So I think that the way in which rights owners have been historically, compensated, those may not apply in the same way. But if you look back 60 years, they didn't apply in the same way anyway. So, there are different business models for different stages in growth of media types and technology. And I think it's a matter of, really, really smart content creators are doing things that allow them to maintain control over their content and do so in a way where they can make money.
I think the real answer to your question kind of depends on what type of media you're talking about. Is the rights owner a large media company? Is it an indie band? Or is it a consumer? Assuming you mean large media, every type of media has its own unique issues. When it comes to video, the large rights owners, whether it's Time Warner or NBC or CBS, they are starting to syndicate their content, let it out there, and try and support it with ads. It's just taking a while because the business model has yet to be shown to prove it's better than what they've been doing. It's expensive to serve that video, particularly on demand, and the dollars just aren't there yet. So they're going, they see it, it's just tough. So the opportunities are potentially to create the infrastructure that enables them to do that, because they don't tend to build as much in-house as they do look for best of breed.
I think you've raised one of the most interesting but thorny questions. We could go another round and probably would need to invite a few other people to really dig into that. But there are no easy answers. Hulu is an extremely interesting property. I mean, frankly, in some ways, it should have been something Yahoo did as the next evolution of what they were doing. But it's hard, very, very hard.
So I think what we should do is, in order to keep on schedule for the next things, is that we wrap up. I'd really love to thank you three. You did a great job. Thank you so much.